Hi folks, welcome to our final video for our comprehensive example HR Tack, and what we're going to do here is the final step in the accounting cycle, which is closing and preparing the post-closing trial balance. So you'll remember in our last video where we left off is we had prepared the adjusted trial balance, and from this we had prepared our statements. We did the income statement first, so we went and found all our revenues and our expenses, anything we could find that was related to calculating net income, and we did our income statement. Then we used the amount of net income from the income statement and the dividends declared to do the statement of retained earnings, and then after that we did the balance sheet, and we took the final balance for retained earnings from the statement of retained earnings to do that balance sheet so we could get an updated balance on retained earnings. Now what we're going to do is we're going to go through a process known as closing the books. So when we close, I made some quick slides here for you. We close what we call temporary accounts. So what are temporary accounts? Temporary accounts are any accounts on the income statement plus the dividends declared account that's on the statement of retained earnings. Why are they temporary? Because we're collecting revenues and expenses for what we would call a period of time, or for, in our example, for a year. That's why the income statement says that we calculate or prepare an income statement for a period, for a year, for the month ending, for the year ending. It's only for a period. That's why we do the statement of retained earnings for the year or for the month, whatever that period is, because we only declare dividends for a period of time or over a period of time. We want to make sure that as we go from one period to the next, whether it's from 1 month to the next or 1 year to the next, we don't mix up revenues and expenses from last year with this year. We want to make sure that we don't mix up dividends declared last year with dividends we declared this year. We want to keep them separate. So what we do is we zero out or close out revenue, expense, and dividends declared accounts, and those are known as temporary accounts. Now, accounts that are on the balance sheet, they don't close out. Their balances from 1 year to the next, they keep rolling forward, right? So cash never gets zeroed out, because if you have cash of $5,000 in the bank, the only way it would get zeroed out is if you went and withdrew it all, right? But there's no accounting entry that we make to zero out balance sheet accounts. Those balances accumulate. So they're called permanent accounts. We call them permanent. All right. So now with the closing process, what does it do? By closing out revenues and expenses, we're transferring net income or loss and dividends, which is our dividends declared, okay, into retained earnings. And the closing process will establish zero balances in all the income statement accounts as well as your dividend accounts. The dividend means dividends declared. So what we've got here is the format of the closing entries. Now I think in your text they only use 2 entries, but I like to use 3 just to kind of demonstrate for you. It's a little bit easier, I think, for students to grab, because for most of you this is the first time you'd have seen this. To close out all of our revenue accounts, which again are temporary on the income statement, we're going to debit each and every revenue account, because don't forget your revenue accounts have a normal credit balance. But when you want to give them a zero balance or set them to zero, you got to debit them, do the opposite, right? So we're going to debit each individual revenue account and credit retained earnings for the total of all of our revenue accounts. Similarly with the expenses, expenses are normally debit balances, right? So to zero or close them out, we're going to do the opposite. We're going to credit them all, right? And then each and every account gets credited, and then we're going to debit them for the total expense amount that, or debit retained earnings for the amount or total of all those expenses. And you can get your total revenues and your total expenses. You can get that from your income statement. So we're going to use the income statement to help us close out the revenues and expenses on the income statement. Then we can look at our statement of retained earnings and we know that dividends declared has a debit balance. Whenever we declare a dividend, we debit dividends declared. So therefore, it has a balance which is debit. So if we want to zero it out, we got to do the opposite, which is to credit it. And when we credit dividends declared, we know when we do our statement of retained earnings, it reduces retained earnings. So that means we're going to debit retained earnings. So the reason this closing process and doing these entries is important is because all we did up to now when we did the statement of retained earnings is calculate the ending balance of retained earnings. We didn't actually update the retained earnings balance. So if you'll remember, in your adjusted trial balance, we have a balance in retained earnings here of $5,700, right? Now, we already know, because we've done our statements, we already know that from the statement of retained earnings, our ending balance of retained earnings is $6,085. So the problem or the challenge we have is how are we going to get that retained earnings from the balance on the adjusted trial balance, which is $5,700, to the balance in the statement of retained earnings, which is $6,085. The closing process does that for us. So let's show you how to do it. Like I said, go to your income statement first and use that to find all the revenue accounts, of which you have 2, and all the expense accounts, of which you have 6, and you're going to close each and every account to retained earnings. So the first entry we're going to make is to close out what I called R here, all your revenue accounts. I'm going to, because they have normal credit balances, my sales revenue and my interest revenue, I'm going to debit them. So notice here in my general journal, I'm going to debit the sales revenue to zero it out, debit the interest revenue to zero it out, and then I'm going to credit retained earnings to balance. So this entry is done to transfer the sales revenue and interest revenue balances to retained earnings, or in other words, to close out the sales revenue and interest revenue accounts. So once I post these to the T accounts, the T accounts for sales revenue will be 0, the T account for interest revenue will be 0, and this $34,800 would be added on to the $5,700 from the adjusted trial balance to build up the balance in retained earnings. Now we're going to reduce the balance in retained earnings a bit. Why? Because now we're going to close out all these expense accounts. And remember we said the expense accounts have a normal debit balance, so to zero them out, we're going to credit them. So I can go again to my income statement and see what all my balances are. I got them all here. $16,900, $7,100 for supplies expense, and all the like. Go down there and credit those accounts. Why? Because don't forget they're normal debit balances that total $33,915. So in order to close out each of these debit balances, you got to credit them to zero them out. And then when we zero them out, we have to debit retained earnings. So we went from $5,700 in retained earnings, we increased it by $3,400, and now we're going to reduce it by $33,915. So let's pause here for a minute and just look at some samples. We're not going to do T accounts for all the revenues and all the expenses, but just to demonstrate what it would look like. So let's look at sales revenue and let's look at wage expense. If we go to our sales revenue, we know from our income statement it started at $34,050. We closed it when we debited sales revenue and credited retained earnings. Remember, we debited sales revenue here, that's the green line, and part of that $34,800 includes this $34,050, right? So we debited the sales revenue, right, to zero it out, right? And then we come to a zero balance. Similarly with wage expense. Wage expense started out at $16,900 from your income statement. But when you credit it as part of the entry to close out your expenses, you credit that account and that gives you a zero balance. So it's like you put $16,900 into wage expense on the debit side, and when we closed it out to zero out all our expenses, we now have a zero balance. Now, what happens to retained earnings? Well, we said earlier we started retained earnings with $5,700. That again is on your adjusted trial balance. You'll remember when we closed out our sales revenue account and our interest revenue account, that total of $34,800 was the total of all of our revenues. And we can see that here on the income statement. So we credited retained earnings $34,800. So that actually increased our retained earnings by $34,800. So whenever you zero out revenues, you're going to increase your retained earnings through that closing process. But don't forget, we also closed out our expenses here, right? And our expenses totaled $33,915, which is our total debit to retained earnings. So we have to credit those expenses and debit retained earnings, or reduce retained earnings, by $33,915. So that goes on the debit side. Now, how do we get to $6,085? We know this is our ending balance because it's on the statement of retained earnings. Well, now let's go to the statement of retained earnings and refresh our memories to show that we actually reduced our retained earnings by $500 because that was the amount of the dividends that were declared in this year. So the dividends declared is a normal debit balance. So to zero it out, we credit it and we close it out to retained earnings. So if we have a look at our T account, when we credited the dividends declared to zero it out, we debited retained earnings. So if you took $5,700, added to it the credit to retained earnings that you got when you closed out your revenues here, and then reduced retained earnings or debited it by $33,915, which is what you got when you closed out all of your expenses over here. All your expenses got credited in the closing. You debited that, so you have a balanced entry to retained earnings. And then your final thing was to go to your statement of retained earnings and pick out your dividends declared. Your dividends declared have a normal debit balance, so we credit them and debit retained earnings to close. So that got posted to retained earnings, and so our final balance, if you add up all the credits and add up all the debits, you're going to be left with a net credit of $6,085. So you can use your statements to help you do that. And you'll remember that when you did your balance sheet, you had on there $6,085. That was the calculated amount we had, but now we've actually, through the closing process, updated the actual balance of retained earnings, and we now in the retained earnings account have $6,085 in it. Okay? So you guys, if you want, you can take a little break, go get a glass of water, whatever you need, and we'll come back and then we'll pick up and do the post-closing trial balance. Okay, folks, now let's complete the final step, which is we've done the closing. Now we have to do what we call a post-closing or after-closing trial balance. Well, you can imagine that if we've already zeroed out or closed out all of our revenues, all of our expenses, and our dividends declared, they have zero balances. So on our post-closing trial balance, we should have only balance sheet accounts. That's it. So that's why I'm here on the balance sheet. I have to make sure that all of these accounts, like cash, accounts receivable, interest receivable, supplies, prepaid insurance, equipment, accumulated amortization or accumulated depreciation on the equipment, and all my liability accounts here, as well as my contributed capital and retained earnings, all have balances on my post-closing trial balance. So now all I'm going to do is I'm going to list again the who, what, and when, my three-line title, company name, name of the report, and the date, or as at this date. And I'm going to do a listing of all the debits and all the credits that are in each and every account. And notice here, I do not have any revenue, expense, or dividend declared accounts. I only have balance sheet accounts because it's a post-closing or after closing trial balance. And we do the post-closing trial balance as a check to make sure that before we go into the next year, in our case, going into the next year would be going into January 2010, we want to make sure that going into the year, we start from what we call a balanced position. We've got to make sure that all of our books are balanced at the end of the current year so that when we go into the next year, we know we're starting off from a balanced position. And we'll know that because the total dollar value of all the debits, which is $34,350, should equal the total dollar value of all the credits, which is $34,350. The other thing you noticed is that this order for the post-closing trial balance starts with your most liquid asset, which is cash, and then lists your next most liquid. So it does all of the assets first, then your liabilities, and then it does your equity accounts, contributed capital and retained earnings. And notice it has an order. All your current assets first, cash, accounts receivable, interest receivable, supplies, prepaid insurance. Then all your non-current assets, of which we have equipment and accumulated depreciation on the equipment. All your current liabilities, which are accounts payable, dividends payable, interest payable, unearned revenue, wages payable, and of course, income taxes payable. And then your note payable, which is long-term. And then you have your shareholders' equity accounts. So it goes current assets, non-current assets, current liabilities, non-current liabilities. And then it goes to your equity accounts, contributed capital first, and then retained earnings. So all we did here to get these balances in the post-closing trial balance is we went to our balance sheet. So we took the $3,000 in cash, the $500 in interest receivable. So you can pretty much start your post-closing trial balance with these balances because you've got these current asset accounts, and that's what goes first in the post-closing trial balance. And copy it right over, right? So these numbers are what would appear in your post-closing trial balance. Then you go into your non-current items, your non-current asset items, which we know is your equipment, right? And your accumulated depreciation. And your textbook says you can use depreciation or amortization. The two terms are interchangeable. And don't forget, this is a contra asset account, so its balance is credit. So we have to make sure that the accumulated depreciation is on the credit side. And then we list all of our liabilities in order from current liabilities to non-current. And we pick these balances up right from our balance sheet. And again, we know that the normal balance of liability accounts is credit, so they're on the credit side, right? Don't forget accumulated depreciation, even though it's got a credit balance, it's not a liability. It's a contra asset account. So contra means its normal balance is opposite to the normal balance of assets. The normal balance of assets is debit, so the normal balance of a contra asset is credit, but it's not a liability. Right? And then your contributed capital accounts, as well as your retained earnings. Your retained earnings had a credit balance of $6,085, so we keep that there. And contributed capital was right from our adjusted trial balance. We know that that was $15,000. It's right up here. So we pick that off, and you notice we've got a post-closing trial balance that balances. Notice that $34,350, which is the balance to which our our post-closing trial balance balances to, is not the same as your adjusted trial balance. Why? Because this has got all the revenues and expenses and dividends declared in it. So there's more amounts of debits and more amounts in credit. So even though your adjusted trial balance balances it will balance to your post-closing trial balance will balance to a different number than your adjusted trial balance does, because your post-closing trial balance has all the revenues, expenses, and dividends declared. Those accounts have already been closed out to retained earnings, so they're already in this guy. So this concludes our third and final video on our comprehensive example, HR Tack. And this video demonstrated the closing process and the preparation of the post-closing trial balance. I hope you found it useful.